All right, good Monday afternoon, traders and investors. As we mentioned last week at Finom Group, that we would try to more consistently do kind of a Monday review of our weekend research report. However, I am cutting it at 30 minutes. We're going to go 30 minutes, no more, maybe a little bit less, depending on how quickly we can do this review. And the main reason is, there's a lot of context that is needed to go along with our weekend research report because it is so detailed, it's so involved, it's so informative. There's just a lot to unpack. All right, so here's the title: the market roadmap and investor returns can differ. And we did a roadmap report back on the first week of July. So we were basically 2 weeks off of the June low, which so far is holding. We'll see if it can continue to hold through the course of this year. But the main reason that we did this is because you need a game plan. Look, in this environment, you're just trying to hold your head above water, but you can actually do better than that. We talk about disciplines, the 3 disciplines of investing, right? Fundamental analysis, technical analysis, and quantitative analysis. And a lot of quantitative analysis is data and statistics, historical studies, but it's also basic math. It's basic math that you can introduce to your game plan so long as you know what to look for along the road, along this journey through the bear market. All right, so we know September, the tail end of September, pretty much from the 12th trading day, when you only have 12 trading days left in September, in 23 of the last 24 years, if you were a seller of equities, you would have been profitable in 23 of those 24 years, meaning that the market was down, from basically the 12th to last day forward or along that time period. And that's what this chart is basically showing you. The tail end of September, historically, we take a dive. The S&P 500 downtrends into the end of September, which is quarter. Yeah, that's the end of the quarter. So you get quarter end rebalancing, you get month end rebalancing from the institutions, the pension funds, the hedge funds, you name it, the long short equity funds. They're all rebalancing, and it's just a bad time for markets historically. One of the key focuses, get off my screen. What's she doing there? Advertisements, pop-ups. What are you going to do? Anyways, one of the key focuses that we stress in our weekend research reports is just having a long-term time horizon, right? Time is to your advantage as an investor in so many different ways. But this chart right here speaks to the compounding effects of staying in the market, even adding leverage during these value-oriented periods, otherwise known as market corrections and or bear markets. So that's what this chart speaks to. 30-year time horizon, just compounding effects. Look at the candle. Simple interest or growth, right? If you're growing at, historically, the S&P 500 is growing at like 8-9% a year. That's represented by the darker candle. The lighter candle is just the additional compounding effect that you can generate in the market, just staying in the market long term. And this was something that I had tweeted out earlier in the year as well. Well, probably like August. And it basically identified, again, math, just math. Who's right, the rip sellers or the dip buyers? Now, we were still down, even though we had that really significant 17% rally from the June lows to mid-August, basically. Now, if you had bought one share of the S&P 500 every single day this year on an equal weighted portfolio, you would have been up 1.6% in mid-August. Even though the index was down on the year, you would have been up 1.6%. If you had been buying in 3% tranches, you would have been up 5%. Buying in 2%, you would have been up 3%. Staying out of the market or adopting the bear scenario, and most of the bearish price targets for the S&P 500 were around 3,500. We got our profit, didn't we? Yeah, we sure did. Take your profits, folks. This is being recorded live here today in our trading room. And we've traded PayPal all day, and we've had 3 successful trades on that. If somebody can also get it out to our members, if I can ask anybody in the trading room right now, if you can alert our members in the Telegram app, that would be awesome. Anyways, moving on. Let's see, get to some meaty stuff. Who's selling? Well, the millennials have been selling. This chart right here is from Lindsay Bell of Ally Invest, and they had recently done a study over and what they found was in the past 12 months, more millennials sold their investments than any other generation. Right. I mean, you think about, the Robin Hooders, you think about the Wall Street Bets, you think about the Reddit crowd, you think about all the new money that came, after the bottom in the market in March 2020, when everybody was getting those government transfer checks and they just went into trading accounts. Yeah, those folks they don't understand bear markets, meaningful corrections, right? So they've been bailing. They're not thinking in terms of those disciplines that we talked about. They've been bailing on this market. Okay, technicals. We do technicals every week. Last week was options expiration week. And typically, this year, the market has been down during the monthly options expiration week. US stocks have dipped in 7 of the last 8 options expiration weeks this year. Make that 8 of 9, right? So one of the reasons why I like to point that out is because you want to be able to distinguish why price is doing what it's doing. Is there something ominous with that 4+% correction in the market last week, 5+% in the NASDAQ? Or was this part and parcel for a market operation? Monthly options expirations is simply a mechanical operation. And don't get me wrong, the market the expectations were also offsides when it came to the CPI print earlier in the week. But to my point, we want to be able to distinguish. If this was just an ordinary week, I doubt we would have been down 4 and 5% on the indices. We probably would have still been down 1% or so if it wasn't for the CPI. But we can rationalize it as because it's happening because of a market mechanical operation being an OPEX week. And why did the market have that outsized move on Tuesday when the CPI was released? Well, because the CPI wasn't rolling over as hard as many people thought. And that basically suggests that the Fed is going to have to hike rates, and stay at an elevated Fed fund futures rate for longer than prior to that CPI release. And what we saw was a jump in the futures implied Fed funds rate from basically 4% 2 days prior to the CPI release to 4.42%. So the market had a schism, right? Because if the Fed fund futures rate are going higher, as it did that day when the CPI was released, what do you think's happening to yields? What do you think is happening to real yields? And so you get this adjustment in the equity risk premium. And so you have a big move in the real rates. You had a big move in yields. You have a big move in Fed fund future rates. You're going to have a big move in the equity market. Again, this is just about knowing the whys. This also, while a very big move, was a mechanical operation centered on the equity risk premium, shifting dramatically because of the underwhelming CPI report. Some charts that we had looked at in the previous week, we wanted to update. It was a bad week in the market, folks, but we were still seeing some positive signs when we look at performance ratios. In the previous weekend report, we were looking at consumer discretionary versus the S&P 500. We want to get an update. I mean, that was a bad week. You would expect some deterioration in consumer discretionary relative to the S&P 500. We didn't see any of that. And don't get me wrong, everything got sold that week, but they still weren't selling consumer discretionary stocks at the same pace or worse than they were selling the S&P 500. So the performance ratio of consumer discretionary versus the S, it kept going higher. On an absolute basis, consumer discretionary stocks or the sector ETF was down, but it was not down as much as the S&P 500. And it continues to bring us to the question, why aren't they selling consumer discretionary stocks? If everybody's talking about a recession, an inevitable recession, as they say, the market just isn't buying that narrative. The other thing that I appreciated is we actually on the week, this performance ratio got even better for the RSI, only slightly, but the RSI did tick higher. We went a little bit deeper, right? Because consumer discretionary versus the S&P 500 is one thing, but what about consumer discretionary versus consumer staples, otherwise known as offense or cyclicals versus defense? And so what we see here is a little bit of a turn down, but not much movement on the whole of the week, not much movement at all. You're still in this really nice defined uptrend in consumer discretionary relative to consumer staples, in offense versus defense. We found resistance indeed, and that's signaled here with the horizontal line. And what you would want to see going forward, what you would want to see is a breakout above this level. Hasn't happened yet, may not happen. We don't want to see a breakdown below this uptrend trend line here, but we have to remain open-minded. There's a possibility in either direction here with this performance ratio. But again, when you combine this with this, there are bullish things happening in the market when you look at certain performance ratios. And here's the S&P 500 we looked at as a whole. Unfortunately, we did break below 3,900. And while some of these performance ratios lend some degree of positivity or bullishness to the whole of the year at this point, this one, is the absolute. Unfortunately, that break, usually good things don't happen when you break a key support level. Usually, not always. We're still not yet making lower lows. This could turn out to be a false breakdown, but we need more time. One of the things also that we notice is while we did make a lower low on a week over week basis, the RSI did not. So we have a bit, it's not robust, but it is a bit of a bullish RSI divergence going on here. We made a lower low in price, but we did not make a lower low in relative strength. Maybe that's simply because it was more of a market mechanical operation week. Again, we need more time to find out. We need more price action. Okay, so moving on here, let's see. What are we talking about in this one? Downside probabilities, how far we might be going down, where we might find the next level of support. We've talked about, if this is going to be an 11% drawdown based on, the times that we've had 90% of stocks trading above their 50-day moving average, that would take the index down to 38.32. Larry Williams, who recently did his most updated podcast, if you will, he says, this is the final dip. He thinks that this is going to be the final cyclical dip of the year, and 3,800 could be the support level for which the markets rise into the end of the year, even if not in a straight line. I'm not going to quibble, between 38.32 being this 11% drawdown and 3,800, like not a big deal to me. But we do want to have an idea of what the probabilities are. Once again, same chart we've been looking at last several weeks. Percent of stocks trading above the 50-day moving average fell all the way down to 26% last week, with the S&P 500 just below 3,900. Last time the S&P 500 was here, you can go all the way back to that June low where we cascaded, but we had barely 10% of stocks above the 50-day moving average. The market is stronger today at just below 3,900 than it was in June when it was just below 3,900. That's why I've been saying you need above and beyond the selling pressure that we saw back in June. If we're just going to get back to those levels, we need that much more selling pressure to take place. There's another divergence in a sense, and this speaks to risk appetite. This speaks to hedging activity. This is the options equity put call ratio. And as we can see, 2 weeks ago, we had it jump almost to 85 on the put call ratio. And the 5-day moving average of the put call ratio, that was around 0.81 last week. Now, fast forward to Friday of last week. Friday last week, this is where we finished. The put call ratio finished at a lower level with the S&P 500 at a lower level than when the S&P 500 was at a higher level. We had a higher options equity put call ratio. We also had the 5-day moving average at a higher level. So they weren't hedging as much last week. They were not favoring puts to the same degree that they were 2 weeks ago when the price was higher. A little bit of a divergence in risk appetite in that sense. This is the NASDAQ composite. One of the interesting things as we're looking for some of these kind of bullish divergences in charts, look at the money flow index here at the bottom, right? I mean, we've made a lower low week over week basis. We had a nice, spike there. We had a really nice 4% gain the prior week in the NASDAQ. And so you had a spike in the money flow, but we found a lower low here than the couple weeks prior to that. But the money flow index has not gone back to the former level. And the same thing with the RSI. We made a lower low than the previous 2 weeks, and the RSI is still higher than it was right here. Right? There's a lot of bullish divergences. They don't mean anything until price can validate them. And so, as usual, we need price to validate them. Let's see. A lot of fundamentals here to go over. We've talked about the apartment list. We've talked about the OER till we're blue in the face. It's just not showing up in the CPI report at this point. Even the Zillow, this is the Zillow observed rent index. You see that rolling over, just like the apartment list, rent index. But this is just not being reflected in the CPI yet. It will eventually, but how much it will lag remains to be seen. Which one is this? University of Michigan, we had a bit of a bump it wasn't much, but it was a small bump to the upside in the University of Michigan consumer sentiment. More importantly, since we're talking about inflation, is the fact that we hit the lowest level in inflation expectations from the University of Michigan consumer sentiment report. I mean, the high was in April. We've been down ever since. And the last 2 readings for the 2 successive months have been where a bigger decline has taken place. Now, this wasn't the final monthly reading for the University of Michigan. This is the preliminary data. We did see also by the end of the week, after all the hoopla from the CPI, and with the University of Michigan data coming out on Friday, we saw the 5-year break-even inflation rate drop down to almost its best level of the year. So forward-looking expectations for inflation have continued to roll downward. It's only a matter of time, because usually the forward-looking inflation expectations are leading indicators of the CPI, of general inflation data. All right, and then here's the forecast from Goldman Sachs. This is where they see inflation heading. Core CPI, December 2022. They think we'll get down to 5.8%, it looks like. which is about 0.5% off of the August number. By 2023, they see the year over year down to 2.7%, which is essentially 3 points lower, 3 percentage points lower than 2022. All right. A lot of economic data we covered. Man, jobless claims, right? 5 consecutive down weeks in jobless claims. This week we're looking at, tomorrow we're looking at building permits and housing starts, then existing home sales, and of course Wednesday is FOMC day, right? So everybody's going to be on pins and needles. The good news so far this year, every single Fed rate hike day, the market has been up at least 1.5%. At least 1.5% for the S&P 500 every single rate hike day, whether it's been 25 basis points, 50 basis points, or 75, all 4 times the market has been higher. Now, revisiting the 12-month roadmap, this is kind of our starting point because this is the biggest of the big data, right? We were down 20% at the end of June. 6 months into the year, we were down just over 20%, 20.58%. Now, in the second quarter, we were down 15% alone in the second quarter. So this is the forward-looking data next quarter when you've dropped 15%, or next quarter when you've dropped 20% over a 2-quarter period. I mean, most of the time, the next quarter, you're positive. We need to be above 37.85. Otherwise it opens the possibilities that this is a 2008 type of scenario. And if we do go down another 11%, in the end, by the end of the year, it's 11%, folks. 3,900, take off another. Let's just for round number sake say 10%. You take off another 300 points, you're at 3,500. I'm sorry, 3,600. We're right around the June lows, give or take. But the reason why we focus on this data when we're kind of looking at our roadmap is because we also know we're in a bear market. And the market likes to, price in most of it as if it's going to have a recession. Looking at these these past occurrences, a lot of bad news was being priced in, and obviously the next half of the year was really good. So this data here, we want to know what the maximum drawdowns could be, right? Because we're not going to go up in a straight line more than likely. What are the maximum drawdowns based on all these occurrences? And they overlap because, some of these occurrences where you had 15% quarterly drop, 3-month drop, also happened here where you had 2 quarters of 20% or greater market decline. So the 1-year maximum drawdowns average 5.7%, median is 2.3%. 1947, you had an 8%, and naturally, here's that 2009, which was just additional leakage from 2008. So what we did in kind of creating our roadmap based on this data, based on these occurrences, is we took the average and the median. Our starting point on June 30th is 37.85. That's our starting point. At the end of that quarter, at the end of the first half of the year, considering this data and the maximum drawdown data, we're taking the average of the maximum drawdown as shown in the table above after a 3-month 15% plus correction and a 6-month 20% plus bear market. The average maximum 1-year drawdown is 5.7%. We'll call it 6%. We'll round up. So a 6% drawdown will take the S&P 500 from 37.85 down to 35.58. And there it is on our roadmap. What we want to do is make sure we have capital to allocate if the market goes down to that level. Why? Because it's value. I don't care if it's the low. It's still value. Stocks are still on sale. They may not feel like it today, but they will represent that opportunity in the future. So 35.58 was on our roadmap. Oddly enough, the median drawdown. So now we look at the median drawdown. We'll call it 3%, rounding up, right? Show us the worst. I don't need to do 2 point. I'll make it worse. I round up. I'm not rounding down. So that takes it down to basically 36.66. which is the closing low of the year, give or take a point on our roadmap. Where does this 3260 come in? All right, because that's what everybody's thinking, right? Where the heck did you get that from? So the average bear market with a recession, let's say it's a recession, the NBER, they just haven't labeled it a recession yet, but maybe they will by the end of the year. Who knows? Again, let's paint the worst picture possible, so at least we have, an idea of how bad it might get. The average bear market is roughly 35%. Right? Average bear market with a recession. So let's see. I'm trying to speed along here. As we can see in the table above, the average bear market with a recession drawdown since 1948 was nearly 35%. If we plot this additional 14%, right, because we were 21% down on June 30th, we were 21% down. If the average bear market with a recession is 35%, we do our math, we need to draw down another 14% from 37.85, and that would take us to 32.60. And that's how we get this plotted point using additional data, bear markets with recession. So we can't rule this out. And we want to make sure we have capital, we have cash to allocate should this materialize. And those are our points of entry that we would be considering. Why? Because, folks, look at the S&P 500 growth by decade. I mean, the average decade, the S&P 500 grows 200%, right? If you think about compounding 10% annualized return. Yeah, 2000s sucked. And yeah, the 1930s sucked, right? The indexes didn't make any profits. There was no positive return. But does that mean that your portfolio won't have a positive? I mean, that's only down 6% for the decade, down 2% for the decade. Yeah, that's a long time. But it doesn't mean that your portfolio won't generate a return. Remember what we talked about at the top of this weekend's research report. If you're buying, if you're increasing your leverage, you can change the whole dynamics of your returns for any year, let alone 10 years. And remember that no two bear markets are alike. Here's all the bear markets since 1956, basically. Whether it's been an average bear market in a recession, average bear market, no recession. The length of bear markets, and by the way, this is the longest bear market in history without a recession. I have to say without a recession because it hasn't been labeled one yet. And we don't see the conditions as being recessionary. You don't have this kind of job growth when you have a recession. You don't have these kind of consumer spending and retail sales in a recession. You don't have this kind of industrial production at all-time highs if you have a recession. All right, really quickly, so let's get through it. So let's say market's going down. Where do you want to allocate? We got our points of entry, right? We know where we want to allocate. So let's say if our strategy employs 30% cash holdings in a long equity portfolio, this means we are 70% leveraged to equities in a bear market. If we increase our equity leverage at the plotted points noted previously, 36.66, 58, 32.60, using roughly equal incremental leverage, 3.3%, I know that gets you to 9.9%. I don't want to get into all that. We have increased our leverage to 80% exposure. We're adding 10% exposure to the market as it goes down. We desire to add another 3.3%, but we're only really willing to do so if we get kind of a breath thrust, like a zwig or a bam, breakaway momentum breath thrust. Then we'll increase our leverage to the market to upwards of 84%, give or take. All right, so let's do the math. One of the reasons the market takes longer to recoup its drawdown and recover to the former high is because after a drawdown, it takes a bigger percentage. If the market drops 30%, that would take us from the high, we're round numbers, 4,800, drop 30%, that's 3,360. Now, in order to get back to 4,800, though, you need a 42% rally to get back to 4,800. A 30% drawdown plus a 42% rally gets you to 4,800, full recovery. Now, in the math that we're offering here above, and at the former S&P 500 high of 4,800, a 38% drawdown takes you down to 3,360. All right, so now we need 42% holistic price movement to the upside just for the index. But what if, as in our model, we added 10% leverage, right? 3.3%, 3.3%, 3.3% at different tranches down to 3,360, okay? Because we're using that 30% drawdown here. And the average for all bear markets, forget about in recession, not in recession, just all bear markets is 30%. So we're going to do the 30% drawdown, gets you to 3,360, not the 3,260 that we had talked about previously. We're doing the average of all bear markets. The 3,260 was a bear market with a recession, which goes, that tells you that bear markets with a recession are worse in general. So now we're at 3,360, and we've added 10% leverage. So that essentially, even though the index is at 3,360, in our equally weighted portfolio, we're at 3,660. That's our cost average now to get back to even. It's actually 3,660. We're adding 300 S&P 500 points, 300 S&P 500 points to the upside, and it puts the index back at 3,660. So with this understanding, we would only need the S&P 500 rally 32% for our portfolio of index ETF holdings for us to get back to even. We just need a 32% as opposed to the index needing a 42% because of the leverage we've added. Make sense? Good. While the S&P 500 itself needs a 42% rally and may take even 20 months to get back to the former highs based on the average recovery time of all bear markets. Again, the average recovery time of all bear markets is 20 months. Based on the average recovery. Okay, so assuming the bottom occurred in June 2022, and assuming you hold the same drawdown as the S&P 500, you are likely to reduce your recovery time at most to 12 months. Remember, we're assuming in this model, in this exercise, the June low was the low. And for this exercise, it may only take us 12 months to recover, whereas the average bear market will take 20 months to recover. How do we know it's 12 months? Because if the June low was the ultimate low, 12-month return, the average for all those bear markets, in fact, we added 2 more bear markets, the average recovery over 12 months is 43%. We will have already recovered and will be well into profits by the time the S&P 500 has rallied 43% off of its bear market low. Folks, the worst return was 29%, assuming the lows are in. And with that, you have your weekend research report review. If you want to achieve our research report at finomgroup.com, join us, subscribe today.